Good morning everyone, this is Abid Khan and you are watching Karachians Academy YouTube channels. We have started a series of videos on past papers, CIE past papers, AS level accounting 9706. So 9706, paper 1, version 2, multiple choice question based paper. We have selected May-June attempt for 2022. We have done couple of questions till 15 we have done. Today we will start question number 16 and onward. So move on to question number 16. This is your question 16. Question 16, it says, following information is available for a partnership. What is required? Which profit figure is to be appropriated? The profit to be appropriated means the profit which you will take to appropriation account for appropriation purpose. So that is the profit available after interest, after deducting the interest, and which is available for the partners for sharing purpose. So that is we have to find out that profit. What is given here? Profit for the year before interest. This is profit before interest. Also we call it the profit before interest. Interest on partners loan to the firm. This is a business expense, right? This is a business expense. Just 1 minute. This is a business expense. This is not an appropriation. Needs to be charged to the P&L. Interest on capital, this is appropriation. So this is done in the appropriation. Drawings, this is also you do in current account, you can adjust this, right? Let's move. Then what is the profit? Before interest is 115,000. Sorry, 15,000. Very simple question. Interest on partners loan to the business. Interest on loan, which is 1,000. And this will be profit after interest. Profit for the year. Very simple question, 14,000. So your answer will be 14,000. Your answer will be C. So option C will be your answer. Move on to other question. Question 17, which items should not be recorded in the statement of changes in equity? Should not be recorded in the changes of equity. Which item should not be recorded in the statement of changes in the equity? Bonus share. And carefully read what should not be recorded. Bonus share, bonus issue of ordinary share. So this we record. Dividend paid on ordinary share. Yes, this we do. Profit from operations. Profit also we do. But it is saying profit from operations. So we have to look into this. So transfer to general reserves, this we do. So these A A, B, and D, they are normally we take into consideration while preparing a statement of changes in equity. So A, B, and D are not your answer, because it is asking which item should not be recorded. So they all are recorded. So the answer is C. But profit is also charged, is also shown, and it is also taken to. But what profit is taken to? That is profit after interest and tax. Profit after interest and taxes, or earning after profit after tax. You can say profit after tax. So that is basically taken to. And what is operation? Profit from operation? Basically, so the profit before interest and taxes. If I say this is 100,000, just for an example, and there is interest on debenture which is 10,000. If I'm saying 10,000, so you will deduct it, and this 90,000 will be profit after tax. So this profit, so this is basically taken to statement of changes in equity. So this is taken, this profit normally is taken to, but they are saying not this profit, they are saying from operation. So this profit is basically called profit from operation. Profit from operation. So profit from operation we cannot take into changes, statement of changes in equity. So your answer will be C. Move on to D, question 18. What question 18 says? The following information has been extracted from the statement of financial position of a limited company. Right? 6% debenture which will fall due on matured on 2028. 6% debentures, this amount 20. Ordinary share cap at 1. This is ordinary share. 5 years bank loan 200,000. So this is your debt. So debenture, this is also your debt. Share premium, this is the part of equity, retained earning. What is the value of the total equity? So you see, this is your part of equity. This is your share premium is your equity, and retained earning is your equity. So actually you have to add 400, then 50, then 75. So 475 and 50, 525. So total will be, total equity will be 525. Right? Your answer will be A. So we done with question 18. Move to 19. Question 19, on 1st of January, just 1 minute. On 1st of January, X Limited had a share capital of 100,000 ordinary share. This is on 1st of January, which had been issued at a par value of, this is face value or par value. There was no share premium account. Fine. Okay. On 1st March, a bonus issue of 1 new ordinary share for every 5 share. 1 for 5. Issue was made from retained earning. Okay. On 1st of June, after 3 months, company made a right issue. of one new ordinary share for every 4. 1 4 4. Okay, shares held at pre and this right issue was made on 1.5. So 5 is the face value and 0.5 per share is share premium. All the rights were taken up, so all the peoples exercise their right to buy share, right? All the existing shareholders. So how much was recorded in the share premium account? How much was recorded in the share premium account? So we can work out because opening premium was 0. So we will see this. No, so miss, you have to work out the premium. How much premium would be there? Okay, let's move on and see. On 1st March, bonus issue of 1 ordinary share for every 5 means your bonus shares will be equal to how much you have. 100,000 ordinary shares you already have, and for every 5 you have to issue 1 share. So divided by 5, so this will be 20,000 shares. Your bonus shares will be 20,000, right? 20,000. On 1st June, the company made a right issue. So they are making right issue. Right issue is basically an additional capital issued. Is you ask your existing shareholders to subscribe more and you issue new share. And first, it is the first right is given to the existing shareholders. So how much is existing on 1st of June? So initially there were 100,000, and on March you issued 20,000. So 120,000 are shares on 1st of June. The number of shares are 120,000. So the right will be made on to right will be offered to this 120,000 shares. How much will be your right issue? Will be equal to 120,000 shares by 4 shares, means 30,000 right shares you will issue, and they will be issued at 1.5. 1 is share ordinary share, means you will issue this 30,000 shares at $1. This 30,000 will be your ordinary share capital, and 0.5 versus 30,000 of shares, which is a share premium. So this will be 15,000. So they are asking you to tell them and to find out how much the premium would be there, because initially there was premium 0. So only in the premium account there will only be 15,000. So your answer will be B. Move on to next question. Question 20. So what question 20 says? Just 1 minute. Let me go to question 20. This is question number 20. The following information is available for a business. Sales revenue is given to you, purchases are given to you, sales margin, gross margin is given to you, and markup is also given to you. Inventory at the start of the period. This is opening inventory, right? What was the value of closing inventory? So opening inventory is given to you, and you have to find out closing inventory. So not a big deal. So you know well, 33 is a markup. So it means this is your cost is 100%. Markup on cost is 33.33%. So your sales or revenue is basically 133.33%. You have the percentage of sales. You simply divide this by its percentage, you will get the cost. right? So cost of sales will be sales divided by, sales means sales revenue, divided by 133.3333%. So you will reach to your, so how much is sales revenue? This is 500,000. What is the percentage? If this is 133%, or we can say 1.33333, whatever. If you do 500,000, if you divide them by 1.3333333, you will get to very close number. So the close number is coming, COS is 375,000. Cost of sales is 300, and you have worked out cost of sales, and you know when how the cost of sales is worked out. It is in working opening inventory, you add, and how much opening inventory is there? This is 20,000. Then purchases, you add, and how much it is? 365,000. And then you, if any return is there or any drawing is there, so no returns and no drawing, so only the closing inventory. And closing inventory, you deduct how much it is not given to you, and when you do it, you get cost of sales. And cost of sales you already have worked out. This is 375,000, right? So in working the working out the cost of sales, so the process is, you add opening inventory, you add purchases, and you deduct the closing inventory. If you want to find out any missing figures, only simply you adopt a reversal process, and in reversal process, what is being added, you have to deduct that, and this you have to add it. So what will be so 375,000 you have, and from this 325,000 you deduct 20,000, and then you deduct 365,000. So 10,000 will be your inventory, right? So A will be your answer. Clear? So move on to question 21. Let's see what question 21 says and what it asks you. So question 21, let me get to question 21. Okay, this is question 21. The following information, keep it here. The following shows extracts from the statement of financial position of a company, right? Non-current assets 120, inventory, trade receivables, cash at bank, debit balance, okay, it means trade payables, and loan repayable within 12 months. So this is again whatever you are within a year time, your liability which is being paid within a year time is your current liability. So what is the liquid ratio or the acid test ratio? You have to work out, and we know what is the formula for acid test ratio or liquid ratio. This is current assets minus inventory divided by current liabilities. This is very simple. So very easy. So you have to find inventory is there. So you have to simply find out what are your current assets. So this is your current assets. Trade receivables, this is your current asset. Cash at bank, this is your current assets. And current liabilities, this is your current liability. Trade payables and current liability. So this much is your current liability, which is 55,000, and this much is your current assets. Current assets are 35 plus 23 plus 12, which is 70. Inventory already you have 35,000 will be deducted, so 35,000 will remain there. So current assets are 70,000. Inventory is given at 35,000. Current liability is 55,000. So this will be 35,000 by 55,000, right? You simply divide 35,000 by 55,000, you will get 64.64. You will get 0.64:1. So this will be your answer. A will be your answer. So this was very simple question. Move on to question 22. Question 22. Right. So question 22. The cost of direct material is increasing. Note it down. The cost of direct material is increasing. What is the effect if a business uses first in, first out and average cost? Inventory valuation, for inventory valuation in this situation, what will happen to the cost of sales, what will happen to the, and what will happen to closing inventory when you are changing your process from average cost to the, so your ending inventory will be at higher price, right? Because first in, first out, whatever bought first was sold out, and what was latest purchases, they are kept in stocks. So and the currently the prices are on an increasing side. So what will impact? I can give you through very quick example. So we can take one example, an average cost and FIFO. This is just an example. This will explain you. So if I say there is a sales of 100,000, there will be a sales of 100,000. If you deduct cost of sales and if I say your cost of sales is so the cost of sales would be your opening inventory, right, and your purchases, and you will deduct your closing inventory, right? I'm just giving an example. If your opening inventory is 5,000, your purchases are, I'm just supposing, is 75,000. So in FIFO it will remain the same, 5,000 and 75,000, right? And closing inventory. So if I'm saying closing inventory, so in average cost, I'm just assuming if it is 5,000, then FIFO this will be increased. If I'm saying this will be increased by 6,000, so now I can see how much this is my sales, this is my cost of sales. So cost of sales, how much would be there? 85,000 will be your 75,000 cost of sales. So this will be opening 5,000 and closing deducted 75,000 will be your cost of sales. Here plus minus plus minus. If you deduct 6,000, this will be 74,000, and the difference will be your profit. How much? In average cost, the profit will be 25,000, and in FIFO this will be 24,000. What will be the impact? You see how the profit will get increase. So the closing inventory will get increase. So we will come up from here. So the closing inventory. So we can consider these two. The closing inventory is increasing. So sorry, either this will be or this will be, right? So and rest in closing inventory decreases. This is wrong. So increases. So the profit for the year decreases? No. Our profit is increasing. The cost of sales is increasing? No. Yeah, it is increasing. It is cost of sales is also decreasing. So if you can see D, your closing inventory will increase. Yes, closing inventory is increasing. And your profit for the year is increasing. Yes, profit for the year is increasing because 74 and this will be 26,000. 74 when you deduct, my apology, this will be 26,000. So this will also be increasing, and cost of sales, you see cost of sales is decreasing. So cost of sales from 75 to 75,000. So your answer will be D. So we have done with this is the last question. So 23 we will do in our next video. So that's for all today. If you have any question or clarification, you can write your comment on the below of this video, and we will try to get back to you. Thank you very much, and bye for now.